Hello, my name is Manal Corwin, and I am head of KPMG's International Tax Practice. As promised, the OECD has recently released reports and recommendations on 7 of the 15 action items identified in its action plan to address concerns about base erosion and profit shifting, or BEPS, originally published in 2013. These reports represent the consensus policy views of 44 countries and will be presented to the G20 finance ministers at the end of September 2014 and the G20 leaders in November of 2014. In 2 reports labeled as final, the OECD addresses the challenges of the digital economy, Action Item 1, and the feasibility of a multilateral instrument to implement some of the BEPS recommendations, Action Item 15. With respect to the digital economy, the OECD concludes that while certain features of new business models emerging in the digital economy exacerbate BEPS concerns, it is not appropriate to ring-fence the digital economy in addressing those concerns. Rather, the report recommends taking account of these features in the context of the work being done on other action items, including the work on transfer pricing, the work on CFCs, and the work on artificial avoidance of permanent establishments. With respect to the consideration of a multilateral instrument, the OECD concludes that such a legally binding instrument is not only feasible under international law, but also desirable as a means to implement tax treaty BEPS-related measures in a fast and effective manner. Accordingly, as part of its work in 2015, the OECD plans to work on a mandate for the negotiation of such an instrument. The OECD also issued an interim report on addressing harmful tax practices, Action Item 5. In this report, the OECD noted that it had made significant progress on seeking transparency on ruling regimes and reinforced its scrutiny of patent or innovation boxes, signaling the intent to require nexus to substantial activity in connection with such regimes to avoid being labeled as harmful. In addition to these 3 reports, the OECD also issued 4 reports with draft recommendations relating to addressing hybrid mismatch arrangements, Action Item 2, treaty abuse, Action Item 6, transfer pricing aspects of intangibles, Action Item 8, and transfer pricing documentation, Action Item 13. While all 4 of these reports suggest that there is more work that needs to be done in 2015, it is notable that the OECD singles out the recommendations on neutralizing the effect of hybrid mismatch arrangements, stating that jurisdictions can begin to implement these recommendations now. These recommendations seek to neutralize the effects of so-called hybrid mismatches by adopting a series of linking rules to prevent multiple deductions for a single expense, deductions in one country without corresponding taxation in another, or the generation of multiple foreign tax credits for one amount of foreign tax paid. The report on hybrids defers resolution of several substantive issues as well as the development of implementing guidance and transition rules until September of 2015. The OECD also issued a draft set of recommendations to address treaty abuse. Specifically, this report recommends that every treaty should contain certain minimum safeguards against treaty abuse. The minimum safeguards contemplated include either a U.S.-style limitation on benefits provision that sets out a series of objective tests as a condition for obtaining treaty benefits, coupled with targeted rules to deal with conduit arrangements, or a general anti-abuse rule based on the principal purpose of certain transactions or arrangements, or both a limitation on benefits rule and a general anti-abuse rule. The report makes a number of additional recommendations to curb treaty abuse, many of which already can be found in U.S. treaties. Importantly, the report defers consideration of the treatment of collective investment vehicles until 2015. The final 2 reports in this round of deliverables relate to transfer pricing. The first of these reports deals with the transfer pricing aspects of intangibles, Action Item 8, and incorporates much of the guidance previously included in the prior discussion draft on this issue. The report, however, defers consideration until 2015 of some significant issues relating to the treatment of intangibles, including dealing with so-called cash boxes and the allocation of profit to capital and risk. The second report, dealing with transfer pricing documentation and country-by-country reporting, outlines very specific guidance on the information that multinationals will be required to report about their income, taxes, and indicia of economic activity in every jurisdiction in which they operate. In particular, the report recommends that multinationals maintain and provide governments with 3 separate documents: a master file, a local file, and a country-by-country report. The country-by-country report would require multinationals to report annually, and for each tax jurisdiction in which they do business, the amount of revenue, profit before income tax, and income tax paid and accrued, their total employment capital, retained earnings, and tangible assets in each tax jurisdiction, and the identity and business activities of each entity within the group doing business in a particular tax jurisdiction. While the content of these reports is considered final, consideration of implementation issues, including how the reports will be delivered to governments and confidentiality concerns, are expected to be addressed in 2015. So what should we expect in 2015? It is anticipated that 2015 will be another prolific year for the OECD. In addition to tying up the not insubstantial loose ends and finalizing the recommendations from the 2014 deliverables, the OECD has promised reports and recommendations on the 8 remaining action items, including the treatment of CFCs, interest deductibility, the artificial avoidance of permanent establishments, the additional transfer pricing action items, and addressing and improving dispute resolution. Notwithstanding the fact that there remain many unanswered questions and significant additional guidance is contemplated in 2015, the report and recommendations on the 2014 deliverables has provided a clearer indication of the types of changes that will likely have a significant impact on multinationals. It is also clear that given the nature of changes contemplated, there will be a significant impact on U.S. multinationals, even if the U.S. is slow to make legislative changes adopting these recommendations. Accordingly, multinationals need to pay close attention to U.S. and non-U.S. government statements regarding the implementation of the OECD recommendations and begin preparing for the likely impacts. In particular, given the inevitability of country-by-country reporting, and the likelihood of early adoption of the recommendations on neutralizing the effects of hybrid mismatch arrangements, it is important that multinationals begin the internal analysis and planning necessary to be prepared for these particular action items. Finally, with respect to the 2015 deliverables, multinationals should keep abreast of the discussion drafts and consider engaging in the consultations anticipated in the coming months.